the growth engine just stalled. Consumer defensives lead the market higher as the QQQ drops 2% amidst a brutal industrial sell-off. The VanEck Semiconductor ETF dropped 3.4%. Lab scores at 58 out of 100. Hold. While headlines focus on volatility, the core signal remains the massive capital expenditure required for AI infrastructure. This pullback reflects a temporary cooling in the hardware supply chain rather than a fundamental shift in demand. Our deep dive reveals why this dip is a structural reset. SMH dropped 3.4% today to $570.91 as geopolitical friction in the Middle East collided with hot inflation data. This move is a structural reaction to rising input costs and energy volatility. NVIDIA represents 15.2% of the fund and remains the primary driver of the AI hardware cycle. Its dominance in H100 and B200 GPU shipments dictates the fund's momentum. TSMC follows at 9.4% weight. It acts as the global foundry bottleneck for every major chip designer in the index. Micron sits at 7.8% because high-bandwidth memory is now the critical performance floor for generative AI workloads. While the short-term trend remains technically bullish, the geopolitical environment is shifting the risk floor. Trump's rhetoric regarding Iran and actual strikes in the Gulf of Oman are forcing a risk premium back into the sector. Semiconductors are the most energy-sensitive component of the tech stack. Higher oil prices translate directly to increased operational expenses for power-hungry fabrication plants. We are seeing a rotation out of high beta growth as the Nasdaq 100 reacts to the 0.6% year-over-year CPI print. This inflation data suggests the Federal Reserve will keep borrowing costs elevated for capital-intensive chip expansions. The RSI at 51.5 indicates that despite today's selling, the fund is not yet oversold. Institutional capital is waiting for clarity on the yield curve. The lab views this 3.4% slide as a repricing of the hardware supply chain's vulnerability. SMH is an aggressive bet on global logistics and energy stability. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, Qualcomm at -6.9%, carrying 5.1% of the fund. VanEck markets SMH as a diversified semiconductor vehicle, but the data reveals a highly concentrated engineering instrument. The top 5 holdings represent 47.2% of the total net asset value. This is not a broad sector play. It is a heavyweight bet on 5 specific balance sheets. NVIDIA at 15.2% and TSMC at 9.4% create a massive dependency on the advanced logic supply chain. Intel holds 7.2% of the fund. This feels like a legacy anchor in a portfolio otherwise optimized for AI growth. Intel's struggle to regain process leadership creates a structural drag on the fund's overall efficiency. Over the last month, SMH lagged its peer SOXL by 3.2 percentage points. This underperformance stems from SMH's specific weighting toward these top-heavy components during a period of hardware dispersion. The year-to-date return of 6,624.1% is a statistical outlier. It dwarfs the 3-year average of 59.8%. This massive divergence indicates the fund is currently riding a vertical expansion in AI valuations that historical averages cannot justify. We look at the expense ratio and AUM as the price of admission for this volatility. When 47.2% of your capital sits in just 5 names, you aren't buying a sector. You are buying a concentrated momentum engine. The lab views this structure as a high-performance tool that requires active monitoring. SMH is an aggressively engineered vehicle that prioritizes top-tier hardware dominance over true sector diversification. SMH is trading at a 3.4% discount to NAV, while the 5-day volume is 42% higher than the 20-day average. That's not just inflow, that's a liquidity squeeze. Institutions are piling in, but retail is still sitting on the sidelines, waiting for the headline noise to clear. The discount tells you exactly who's driving the bus. The big players are buying the dip on fundamentals, not the narrative. RSI at 51.5 and the 20-day moving average $586.89 above the 50-day $519.79. Momentum is still pointed north, but the MACD bearish crossover is the first warning that the tape is getting tired. That's not a sell signal, it's a structural pause. The fund's YTD return is a staggering 66.2%, but the 3-year average is a far more modest 59.8%. Wall Street keeps selling the AI semiconductor boom as a perpetual growth story, but the numbers show you the real play. Episodic hardware refresh cycles driven by policy, not hype. The macro narrative is screaming trade war and tariff uncertainty, yet SMH's top holdings, NVIDIA, ASML, TSMC, are all export-controlled or geopolitically shielded. The lab's red. The fund's marketing leans on diversified tech exposure, but the actual portfolio is a concentrated bet on 3 companies that print chips the US government won't let China touch. That's not diversification, that's policy arbitrage. The verdict: SMH is a structural trade, not a thematic one. Buy the discount, respect the MACD, and ignore the headlines. The structural bull case for SMH rests on the insatiable demand for AI infrastructure. The CHIPS Act is injecting $52 billion into domestic fabrication, providing a direct subsidy floor for the fund's US-based holdings. This government-backed capital expenditure cycle creates a multi-year tailwind for companies like Intel and Micron. However, the bear case is anchored in restrictive trade policy. Ongoing U.S. export controls on advanced lithography equipment are a direct hit to the revenue ceilings of the fund's largest holdings. These are not vague headwinds. They are hard limits on the addressable market for cutting-edge silicon. We are also tracking the Federal Reserve's 5.3% policy rate, which increases the cost of the capital-intensive expansions required to meet AI demand. The technical setup is now at a critical junction. If SMH breaks support at $542.36, then expect rapid selling. The 24.6% concentration in NVIDIA and TSMC will trigger institutional deleveraging. If the price clears resistance at $599.46, then the bearish MACD momentum is invalidated. Currently, the Fear and Greed Index sits at an extreme 9. This level of market panic often precedes a tactical bounce. The surge in AI workloads is turning chips into the highway for massive data streams. The lab gives SMH an AI score of 58 out of 100. A rational investor holds current positions but waits for a confirmed bounce off support before adding fresh capital. SMH is a powerful instrument that requires strict adherence to technical levels. The leveraged semiconductor ETF fell 10.4%. Lab scores 55. Hold. The $52 billion CHIPS Act injects massive, multi-year subsidy dollars into U.S. semiconductor fabs, accelerating capacity expansion. Those subsidies underpin near-term earnings growth, keeping the leveraged semiconductor ETF fundamentally strong despite today's pullback. Our deep teardown shows exactly how that funding reshapes wafer capacity, yield curves, and the ETF's leveraged exposure. SOXL cratered 10.43% today to close at $180.65, a move that highlights the brutal mechanics of the Direxion daily semiconductor bull 3x shares. This instrument is engineered to amplify the daily performance of the SMH index by 300%. We warn that the daily reset mechanism creates structural volatility decay that erodes capital during sideways markets. It is a precision trading tool, not a long-term storage of wealth. NVIDIA represents 15.2% of the weight and serves as the primary volatility engine. When the market questions the sustainability of AI capital expenditures, NVIDIA's premium evaporates and SOXL's leverage turns into a liability. TSM at 9.4% adds a layer of geopolitical fragility to the fund. Today's rhetoric regarding potential strikes in the Middle East and renewed trade friction directly impacts the foundry's global logistics and risk premium. MU at 7.8% ties the fund to the cyclicality of memory pricing, which is currently sensitive to high-bandwidth memory supply constraints. While we see emerging research into spiking neural networks as a future threat to current GPU dominance, today's move was driven by raw macro fear and regional conflict noise. The staggering 43,271.4% YTD return is a result of extreme sector momentum amplified by leverage, but it does not account for the drawdown risk we witnessed in this session. The combined exposure means SOXL is now a high beta proxy for global trade stability. This is a concentrated bet on a fragile supply chain. Open the hood on the leveraged semiconductor ETF. The largest single dragging, Qualcomm at -6.9%, carrying 5.1% of the fund. Data for the specific expense ratio and AUM is currently unavailable in the lab's feed, but we judge the efficiency of this instrument by its tracking error and holding quality. SOXL's top 5 holdings command 47.2% of the total net asset value. This concentration exposes the marketing myth of diversified exposure. You are not buying the semiconductor sector. You are buying a 3x levered bet on 5 specific management teams. NVIDIA at 15.2% and TSM at 9.4% mean nearly a quarter of your capital is vulnerable to a single point of failure in the Taiwan Strait. We find the 7.2% allocation to Intel to be a structural drag on the fund's DNA. Including a legacy manufacturer struggling with node transitions alongside high-growth names like AMD at 7.6% dilutes the fund's performance during expansion cycles. Over the last month, SOXL outperformed its base ETF, SMH, by 3.0 percentage points and outpaced TQQQ by 12.3 points. This proves the fund is successfully capturing the hardware over software dispersion trend. The 3-year average return of 109.4% shows that while the YTD gain of 43,271.4% is staggering, long-term holders are punished by the leverage reset during periods of consolidation. The lab views the fund design as a high-performance engine that is currently carrying too much legacy weight to be a pure AI play. It is a concentrated momentum vehicle, not a balanced sector representative. SOXL is trading at a 10.5% discount to NAV right now. And that's not a glitch, it's a narrative disconnect. The 5-day volume is 42% higher than the 20-day average, so institutional money is still flowing in, but retail is dumping shares faster than the NAV can keep up. That discount is the market telling you the story Direxion is selling. 3x leveraged semiconductor exposure doesn't match the reality of tariff headlines and trade war chatter. The RSI at 51 is neutral, but the 20-day moving average is $59 above the 50-day, so the momentum is still upward. The discount is just retail panic, not fundamentals. Here's the PR decode. Every headline screams Trump tariffs, trade war, Greenland, but the actual revenue drivers inside SOXL, NVIDIA, AMD, Broadcom, are selling silicon that powers on-device generative AI, not cloud-dependent SaaS. The lab's read. The fund's narrative is stuck in 2023 semiconductors equals China exposure, while the real story is 2026 semiconductors equals GDPR-compliant edge AI. That's why the discount exists. Retail is still trading the old story, while institutions are buying the new hardware cycle. Verdict: SOXL's discount is a retail sentiment lag, not a sector lag, and it's a buying window for anyone who understands the hardware shift. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The structural bull case for SOXL is anchored by the $52 billion CHIPS Act. This is not just government spending. It is a direct subsidy for the domestic fab expansion that benefits the equipment and design firms inside this fund. This policy creates a synthetic floor for demand that the market is currently discounting due to short-term volatility. However, the bear case is a hard reality. U.S.-China export bans on advanced lithography tools. This policy shift directly caps the revenue potential for the 24.6% of the fund concentrated in NVIDIA and TSM. We track this as a permanent reduction in the total addressable market for high-end silicon. The CNN Fear and Greed Index is currently at 9, signaling extreme fear. Historically, this level of capitulation precedes a violent relief rally. We are watching two specific technical triggers. If SOXL breaks below the $171.62 support level, then the bearish MACD momentum will accelerate, and we expect a total liquidation of the momentum crowd. If the price clears the $189.68 resistance, then the structural bullish trend is reconfirmed and the 3x leverage will work in the investor's favor. The lab gives SOXL a score of 55 out of 100. This is a neutral rating that reflects a balanced risk-to-reward ratio. A rational investor does not chase this volatility. We wait for a confirmed bounce off support before deploying capital into this leverage structure. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH held steady while SOXL lingered, both scoring mid-range holds today's market. Is today's move in SMH a buy-the-dip moment or the start of a real breakdown? Comment your call. Remember, this is not financial advice. It's purely educational, and you should conduct your own due diligence before any trade. Past performance is not a guarantee of future results, and market conditions can change rapidly, so always remain vigilant. Subscribe so you don't miss Thursday's deep dive. We're tearing down ASML. Stay sharp, and see you next time.